This presentation is for Chapter 2, Part 2, the balance sheet. Other assets that are included in property, plant, and equipment include land, buildings, leasehold improvements, construction in progress, and equipment. All are depreciated with the exception of land. Land is never depreciated. Property, plant, and equipment should only include those assets that are currently being used in the operations of the business. If any assets, such as land, are not being used but are held as investments, they should be placed in other assets. Buildings included in property, plant, and equipment should include not only the stores, but also the corporate offices of the company. Leasehold improvements are additions that are made by the company to lease structures. The leased property and improvements will revert to the owners at the termination of the lease, which affects the amortization period of the leasehold improvements. These items should be amortized over their useful life or the life of the lease, whichever is shorter. Many companies will construct their own assets, including new buildings. All of the accumulated costs for these assets are held in an account called construction in progress until the assets are completed and placed into use. Equipment used in the business is reported at the original cost of the machinery and includes many items such as centralized computer systems, equipment, and furnishings for offices, delivery trucks, etc. The relative proportion of fixed assets in a company's asset structure will largely be determined by the nature of the business. Fixed assets are most prominent at the manufacturing level. Retailers are next because they require stores and buildings in which to sell products, and the wholesale segment requires the least investment in fixed assets. Goodwill arises when one company acquires another company in a business combination accounted for as a purchase for a price in excess of the fair market value of the net identifiable assets acquired. The excess price is recorded on the books of the acquiring company as goodwill. Goodwill must be evaluated annually to determine whether there has been a loss of value. If there is no loss of value, goodwill remains on the balance sheet at the recorded cost indefinitely. If the current book value exceeds the current fair value, then the excess book value must be written off as an impairment expense. Any assets that have not been listed previously will be shown in other assets. The types of assets that one might find include property held for sale, startup costs associated with the new business, the cash surrender value of life insurance policies, long-term advance payments, and intangible assets other than goodwill. Liabilities represent claims against assets, and current liabilities are those that must be satisfied within 1 year or the current operating cycle, whichever is longer. Non-current liabilities are those that are not due within 1 year or the current operating cycle. Some of the most common current liabilities include accounts payable, notes payable, the current portion of long-term debt, accrued liabilities, and unearned revenue. Accounts payable are the short-term obligations that arise from credit extended by suppliers for the purchase of goods and services. When the bill is paid, the accounts payable is satisfied. The amount of accounts payable can vary depending on the credit policies of the vendors, economic conditions, and the cyclical nature of business operations. This is a schedule of the liabilities and stockholders' equity sections of the balance sheet for Sage Inc. for the periods ending December 31st, 2016 and 2015. Another current liability is short-term debt. This is also referred to as notes payable and consists of obligations in the form of promissory notes to suppliers or financial institutions due in 1 year or less. Commercial paper is a type of unsecured short-term debt that is issued by companies with high credit ratings. The maturities are normally less than 270 days and carry discounted interest rates. Most companies have a line of credit with suppliers and/or financial institutions that they can draw upon as needed. When a firm has bonds, mortgages, or other forms of long-term debt outstanding, the portion of the principal that will be repaid during the upcoming year is classified as a current liability. Accrued liabilities result from the recognition of expenses prior to the payment of cash. They include amounts for salaries and wages expense, interest expense, and other expenses required to be accrued. There are also reserve accounts that are often set up for the purpose of estimating obligations, such as warranty costs, sales returns, or restructuring charges. Reserve accounts can be identified by reading the notes to the financial statements. To illustrate the accrual of interest expense, assume that a company has a $100,000 note outstanding with a 12% interest rate due in semi-annual installments on March 31 and September 30. For a balance sheet prepared on December 31st, interest will be accrued for the 3 months of October, November, and December. Multiply the $100,000 times the 12% interest and divide the $12,000 annual interest by 12 to determine the monthly interest of $1,000. Then multiply the $1,000 times the number of months, 3, to determine the interest accrual of $3,000. Unearned revenue or deferred revenue results from the receipt of cash payments prior to providing services or products. These amounts are recorded as liabilities. After the services or products are provided, the amounts are transferred to the actual revenue accounts. Deferred income taxes occur because of differences in tax and financial accounting expense and revenue recognition rules that result in temporary timing differences. These timing differences are most commonly associated with the differences in depreciation methods that are used for tax and financial accounting purposes. Other sources for temporary timing differences are installment sales, long-term contracts and leases, warranties and service costs, pensions and other employee benefits, and in subsidiary investment earnings. There are also permanent differences in the tax and financial accounting rules that will not reverse. Some examples of these are municipal bond revenue and life insurance premiums that are not taxable, deductible on the tax return, but are reported for financial accounting purposes. Since some temporary timing differences result in deferred tax assets, a valuation allowance is sometimes required to reduce the deferred tax assets to their expected realizable amounts. These are used when management believes that it is more likely than not that some of the deferred tax assets will not be realized. This is an example of a deferred tax liability resulting from a difference in the depreciation expense for tax and financial accounting purposes. For tax purposes, the depreciation is $100,000, and for financial accounting purposes is $50,000. $50,000 times a tax rate of 34% results in a $17,000 difference in income tax payable on the tax return of $51,000 and income tax expense on the income statement of $68,000. To determine the deferred tax liability, $17,000, the cash per the tax return, $51,000, is subtracted from the reported tax expense for financial accounting purposes of $68,000. This amount will be due in the future when the timing difference reverses. This is a full illustration of a deferred tax depreciation example with reversing amounts over 3 years. Deferred taxes are now reported entirely as net non-current amounts on the balance sheet. This has changed since your textbook was written. They are no longer separated into current and non-current amounts. Long-term debt consists of long-term notes payable, mortgage, debentures, bonds payable, convertible debt, and long-term warranties. Capital lease obligations arise when the company uses a lease to purchase an asset rather than just lease it. There are criteria that must be met in order to record a capital lease. The recording of a capital lease affects not only the balance sheet but also the income statement. The disclosures required for capital leases are found under both the property, plant, and equipment section of the notes, as well as the commitments and contingencies note. Pensions are the cash payments that are promised to employees upon retirement. The amounts that are required to be paid are determined by an actuary. If the company pays less than the amount that the actuary determines as expense, the net amount remaining is shown as a liability on the balance sheet. Post-retirement benefits are benefits other than pensions that are promised to retired employees, such as health and life insurance. While the expense for these benefits must be estimated and reported in the income statement, firms often do not set aside cash to fund these obligations, causing the firms to report significant post-retirement benefit liabilities. As mentioned previously, most companies will have a note called commitments and contingencies. Commitments refer to the contractual agreements that will have a significant or material financial impact on the company in the future. Contingencies refer to potential liabilities such as lawsuit damage awards that the company may have to pay in the future. The ownership interests in the company are represented in the final section of the balance sheet called Stockholders Equity or Shareholders Equity. This ownership equity is the residual interest in the assets that remain after deducting liabilities. The owners bear the greatest risk because their claims are subordinate to creditors in the event of liquidation, but they also benefit the most from the rewards of a successful enterprise. Common shareholders are not guaranteed any fixed return on their investment, but they have voting privileges that are in proportion to their ownership interest. They benefit from price appreciation when the stock price goes up, but they also suffer when there is a drop in the price of the stock. The common shareholders share proportionately in dividends that are declared by the board of directors. The amount listed on the balance sheet for common stock is the par or stated value of the shares issued and bears no relationship to the current market price, but is a floor below which the stock cannot be sold initially. Additional paid-in capital reflects the amount by which the original sales price of the stock shares exceeded par value. For example, if a company sold 1,000 shares of $1 par value stock for $3 per share, the common stock account would be $1,000 and additional paid-in capital would total $2,000. The retained earnings account is the sum of every dollar a company has earned since its inception, less any payments made to shareholders in the form of cash or stock dividends. The retained earnings are the funds that the company has elected to reinvest in the company rather than pay out to the shareholders in dividends. It is a measurement of all of the undistributed earnings of the company. The retained earnings is the link between the income statement and the balance sheet. Unless there are unusual transactions, the ending retained earnings account is equal to the beginning balance plus net income and minus net losses and dividends. There are other equity accounts in stockholders' equity such as preferred stock, accumulated other comprehensive income or expense, treasury stock, and the equity attributable to the non-controlling interest. This is the stockholders' equity section for Pfizer Inc. as of December 31st, 2013 and 2012. Many of the other equity accounts discussed are shown for Pfizer. Preferred stock carries a fixed annual dividend payment. However, the preferred shares do not have voting rights. Accumulated other comprehensive income includes any unrealized gains or losses in the market value of the available for sale securities. It also includes any change in the excess of additional pension liability over unrecognized prior services costs, certain gains and losses on derivative financial instruments, and foreign currency translation adjustments resulting from converting financial statements from a foreign currency into U.S. dollars. Treasury stock is the cost of shares of the company's own stock that it has repurchased. It is shown as an offsetting or negative amount in stockholders' equity. The equity attributable to non-controlling interest is the minority equity interest in companies whose financial statements have been consolidated with the firm statements that are not 100% owned by the firm. The economic recession of 2008 and many of the market gyrations since then can be traced directly to overvaluation of balance sheet assets, such as the subprime mortgages carried by financial institutions. When there are overvalued assets on the balance sheet, the quality of the information for making decisions is greatly diminished. The type of debt that is used to finance assets, commitments, and contingencies, and the classification of leases is also directly related to the quality of financial reporting. Commitments and contingencies are disclosed in the notes to the financial statements and can provide important information regarding off-balance sheet and other complex financing arrangements. Enron is an example of a company that had extensive commitments and contingencies reported in the notes. There are other balance sheet items that may be found that have not been mentioned in the chapter. The reader of annual reports will encounter additional accounts and will find many of the same accounts listed under slightly different titles. However, the ones discussed in the chapter will provide a sufficient understanding of the basics of most balance sheet presentations in a set of published financial statements. This is the end of Chapter 2, Part 2, the balance sheet.